Hey, it's Stuart. Today's question of the week is a really interesting one. It's from Philippa, and just let me read out the question for you. Philippa writes to me, my husband and I work full time with a combined income of about $300,000. We currently rent invest. We have built up a very robust property portfolio over the last 10 years, consisting of 5 properties worth between $900,000 and $1.2 million each. The loan on each is around about 600,000. So we have 5 mil of assets and 3 mil of debt. That's costing us $50,000 negative cash flow, or 10,000 per property on an interest only basis. So Philippa, well done. That's a great achievement to accumulate that much wealth over what is a relatively short period of time, knowing that property is very much a long-term investment. Anyway, Philippa goes on to say she's got $500,000 of savings, and they plan to buy their home this year, which is going to cost around 1.6. Their mortgage broker has told them that they can borrow $1.2 million. So they put down a deposit of $400 plus $80,000 for stamp duty. The P&I repayments on that loan will be about $150,000 a year. Philippa writes, we think we're flying too close to the sun. The repayment is about 50% of take-home pay. And if we keep all our properties, we don't think we can sleep at night. So here's the question. The question is whether to sell the worst performing asset worth $900,000, thinking that past performance will replicate into the future, or do we sell the best performing asset, thinking that mean reversion will cause it to underperform over the next 10 to 15 years? And it's a great question when you're faced in a situation, we invest to obviously achieve our lifestyle goals. And in this situation, it's for Philippa to buy a family home. She's done all the hard work to build and accumulate that wealth. Let's make that wealth work for you. Now, the best case scenario is buy and never sell. But of course, that's not always possible. And as I said, she's got a whole bunch of investments there that have worked hard for her. And she's got to sell one to execute on our plans. I think that's just perfect. Like, there's no problem with that. The approach in terms of working out, well, which asset do I sell? She's quite right. Philippa's quite right in mentioning that, look, if I've had an asset that's achieved a above average level of growth over a relatively short period of time, 10 years in Philippa's example, maybe I should take that money off the table, because as Philippa said, that mean reversion means that we know periods of above average growth are followed by periods of below average growth. And in terms of property cycles, it tends to move in a growth cycle, followed by a flat cycle, followed by a growth cycle. And you need to hold a property and enjoy just as many growth cycles as you do flat cycles. Now, we know those cycles tend to last somewhere between 5 and 12 years on average. So it's possible if you've gone through a growth cycle, no one really knows if that property, the good property, if you like, what Philippa refers to, is close to the end of that growth cycle. In fact, it could persist, and the growth cycle could persist for another couple of years. But also, if it goes to a flat cycle, you don't really know if that flat cycle is only 5 years or whether it's going to be 15 years. Of course, no one really knows about that. The whole thing about property, though, is to enjoy compounding capital growth. That's where the heavy lifting is going to be done. Philippa's achieved some great outcomes in only 10 years. But if she held those properties for another 20 years, the amount of growth is actually inconceivable at this particular point in time. Like, if I told you the numbers, you'd go, well, I don't really believe it. But it's true. It's, 20 years ago that the same thing was true. So the whole idea is then we buy a $1 million investment property. In 10 years' time, it's worth 2. In 20 years' time, it's worth 4. And in 30 years' time, it's worth 6. So, Philippa, if you sold the best performing property in your portfolio, the one that has probably the strongest attributes, the one that has performed the best, you're going to regret it probably, because you'll look back in 20 years' time and go, oh, that was actually a really good asset. So the thing to do in your situation where you need to divest of an asset is you need to critically analyze all your properties and really consider what do you think the growth rates on these assets will be over the next 1, 2, 3 decades? You really need to make a good long-term decision with that outlook. And then you select the property that has the lowest attributes to drive those capital growth. Or in fact, if you actually conclude you think that asset was a mistake, and sometimes we make mistakes when we're investing, and in the benefit of hindsight, we look back and go, well, that property wasn't quite right. It had some elements that were really retarding its growth. Sell the worst asset. It's always the best thing to do, not selling the best asset. You sell the best asset or the best performing asset, you are absolutely going to regret it in the long run, because you hold those other 4 assets, the remaining 4 assets. If they do their thing, in 20 years' time, you can just sell one of those and repay your home loan. And of course, you'll be using cash flow to repay your home loan between now and then. But I'm saying if all else fails, at least you've got plenty of assets to fall back on. So it's always sell the worst asset. Of course, there are some other considerations. The other considerations are, how much cash and debt will you be able to repay as a result of selling an asset? If I've got an asset and I want to sell something to reduce my debt, and it's fully geared, of course, selling that asset's not going to help me do that because there's no equity in it. So you've got to actually consider the practical aspects. In Philippa's situation, she said that the value and debt are relatively similar across the portfolio. The other consideration is capital gains tax. And I guess that would be a negative with selling the best performing asset. You're going to pay more in capital gains tax today. Where if you sell the worst performing asset, of course, you minimize your capital gains tax. I'm not all about tax, of course, but it's just one of many considerations that you need to think about if you're in the position where you need to divest of an asset. So thanks so much for the question, Philip. It's a really good one. It's a common sort of situation that people come across, and that's how I would approach it. Cheers.